Good evening, sir.
This is freaking happening. So it's funny that I just made a post because for some reason I posted on Facebook and I didn't see like a single like nothing. And usually my posts even one or two I get. So I was wondering if Facebook changed the algorithm because I had the Zoom link on the post.
Interesting. Maybe.
So then I started posting. Okay, tonight. Okay, 2 hours to go, 1 hour to go,
Yeah.
half an hour to go, 15 minutes to go. And now people like messaging me. And then on one of the last posts said, an amazing friend of mine who is converting 70 units into 100, and then Bava. Is Mark, isn't it? It's like, yes, I knew it. I knew it. At the moment you said 70 to 100, give me the link. So I don't think you're going to be, because I had this, I mean, not fear, but it's like, man, will be Mark and I? But it's like, I think it'll be more than two.
So you know what? I have been in webinars. I've hosted webinars where I've been the only person, or there's only been one other person. I don't know if I've been the only person, but I have had webinars where I'm the only person. Or webinars like with one person or two people. It's happened. So it
Yes.
happened.
And the one thing that somebody just messaged me, oh my goodness, I have a small group from the church tonight. Can you record? It's like, well, I will try, but we're gonna do it again in 2 weeks. Oh, thank you for letting me know. So, and that's what I'm gonna do. Take a picture, post. You guys missed it. The wealth of knowledge. Let's connect again. Then somebody comes like, yeah, I'm part of the project. We're doing this together. Let's raise awareness and.
Yeah. No, this is good. I was just putting down my final thoughts, just thinking through this. Usually I do some, like usually I have some images. Usually I have some other things that I put together, and I put together like a really tight presentation. The last few times I've tried to do things in a different way, where I just try to connect with people, and I draw out ideas, but I just really try to watch their faces and connect with them. And so I'm gonna try that this time. Let me know how you think it goes, because if it's something where you think I need, like, no, get that tight presentation, I'm happy to do that too. I love presentations. I do them all the time. So
what I was thinking was like 7 o'clock hits, and then I'm gonna hammer, and it's like, hey, here is Mark, and then give an introduction. Maybe wait a couple of minutes so people join, and then I give the floor, and you take from there. And it's like, yeah, we are working together on this project, and I'm learning so much. Mark is this amazing seasoned guy that is crushing it, and then you take from there and rock and roll. No, so
that sounds good. Is this someone related to you?
that's my sister, yes.
Excellent, excellent.
So I shared on the family groups like, hey guys, come and give me some support.
Yeah, that's good. That's good.
This is awesome. So she's in Tampa, Florida. And my whole family lives, actually. My brother and my youngest sister, they are in Orlando, and then my parents and my other 3 sisters, they are in Tampa. And then I am here on the North Pole.
Definitely the North Pole.
As a matter of fact, and as a matter of fact, this being the warmest winter I ever experienced since I moved to Canada.
Yeah.
Today was 15 degrees. It's like, oh my goodness, we're still in February. I never seen this. But apparently tonight we're gonna see a severe temperature drop. So
yeah, El Nino, I read about that because it was already October was really warm, November was warm, and I was going, what's going on? So I did a little bit of reading, and I guess El Nino is really strong this year, but it should drop off. So like really dry, really, really warm. But who knows? It'll change.
Yes. Oh my goodness, we have a minute to go, and the face is starting to show up, and like that warms my heart. This is awesome. This is very, very, very exciting. So just another minute, and we're gonna get things going. So Bava is in the house, Zilla is in the house, Mark is in the house. We have 2 Marks here, and every opportunity I have to network and to learn, most importantly, learn. I take it, and I am glad that I'm having this opportunity. Okay, 7 p.m. it is. Some more individuals, they may join and jump on the call. I'm glad to see some of my great friends here in this call. And I partner with Mark on a project that he is doing in Regina, Saskatchewan, which is a phenomenal opportunity, not just from the sense of looking to the future, what real estate can actually do, but also tapping into some strategies and some ideas that I had no clue they even are possible. So then, as we connect and having these conversations in regular basis, like why we don't do something to spread the word and get more ears into an educational component, which gives us the opportunity to learn and why not. So, Mark, thank you so much for accepting my invitation and joining my little corner here. I am so honored and so blessed to have you in my path. And I can't wait. I have my paperwork ready to make notes and learn a lot tonight. So please, let's put our hands together like we do this way. Let's put our hands together to Mark, the only one. Mark, friends, welcome. Please take the mic.
Yeah, and what we'll do is I want tonight to be interactive. So that's my desire. Anytime I connect with people, I mean, I love speaking from the stage as well, but you can see people in the audience, but I love seeing people's faces. I love people interacting, and I want you guys to interact here. So that's actually my demand, and I'll show you how I do that. I will ask a question, and if people don't give me answers, I'll just be silent for 5 or 10 minutes. So you guys have to give answers. You have to be involved in some way, shape, or form, which I'm excited about too. I think that more people will be getting in here too. So we'll just get going with this. So where this conversation came from, I'm working on a deal, and I'll share a little bit about that a little bit later. But really, where this came from was there's a lot of noise out in the investor realm, as there always is. So this is not a new thing. There's always noise. Anytime there's a big downturn in the cycle, a big upturn in the cycle, anytime something happens in the economy, something happens with interest rates, something happens with war, whatever it happens, people talk a lot. And in my experience, I'll maybe share a quick story. I have an employee at the building that I'm running right now, and we were talking a little bit about news, and I said, yeah, I don't really pay attention to the news. And he said, oh yeah, me either. He said, I only get my news from real outlets now. I said, well, oh, so like where do you get your news? And he said, Facebook. And I went, oh, like everyone has a different perspective on what a real outlet is, right? For me, I think news is news. So I mean, it's always somebody's opinion, but we got to be careful with it. And this is why. When there's a lot of noise out there, and when we hear everything in the news cycle, things are coming through, we can't get away with it. We can't get away from it, sorry. And when we can't get away from something, when it comes inundates us consistently, it affects what we believe. It is a fact that after about 7 or 8 times of hearing something, we will believe it, even if it doesn't make any sense, even if it's completely untrue. This happened during COVID on both sides, right? This happened during like war in Ukraine, like every situation when we're being inundated with it over and over and over and over again, we tend to have very strong beliefs about it. And sometimes those beliefs are educated, sometimes they're not. Sometimes the people who are teaching us are phenomenal and have our best interests at heart, and sometimes they don't. Sometimes they don't know. And so we've got to be very careful about how we do this. We've got to be very careful where we get our information, what that information is, and we always have to ask, and I'll be really transparent here tonight. We always have to ask, what is in it for the person putting this news out or putting this information out or teaching this thing? Because there's always something in it for somebody doing it. Nobody does it for nothing. That's a fact. Even if it's for me, I want to live out the rest of my years. 50 to 80 are my golden years where I just want to give back to people. But what it gives me, even though I might not be making any money from it, what it gives me is satisfaction. It gives me legacy. It gives me things that I desire. And so I'm willing to work for that. And it's something we've always got to keep in mind. Like something I'm teaching my kids. We just had a great dinner conversation about what would you do for money? Basically, is there any job that would be unethical? And human trafficking came up, and then certain other things came up as we were talking. But legitimately, one thing we constantly teach our kids is think critically. Don't accept something simply because you are hearing it a lot. So I'll give you an example. One example is peanuts are evil. Okay? So in the news, it's in the news cycle right now. People have been taking peanuts and doing really bad things with them, right? What happens? Well, P notes get a bad rap. And just like you'll see, you guys will see this. Those who haven't been through a lot of real estate cycles, when real estate does this, single family homes do this, everyone starts talking about how real estate is risky and bad and evil. And that's just the way news is, okay? It doesn't mean the actual thing has anything wrong with it. It means we need to learn how to deal with it. P notes to me are a brilliant strategy that fits certain scenarios. But we need to know what to do with them. We need to how to protect ourselves. We need to know these things. So this is what I want to talk about tonight. I want to focus on two things. And those are the two areas of real estate that are most problematic with investing. Okay. And so here's my first question for you guys. And you guys can test me out on how silent I will be, okay? I'm going to ask this question. What are the two biggest problems with real estate? The two biggest problems that separate real estate as an investment vehicle from a lot of other investment vehicles. You can put it in the chat, you can come and then just like speak on your mic, whatever you want. What are the two biggest problems with real estate?
So I can start, I think, based on my current scenario, where I find myself being asset very rich, but cash very poor.
Yep.
So it's liquidity is a big challenge for me right now.
Yeah.
And the compound interest, right? Because I put the money and it's sitting there and I can't really do anything despite of the wealth or the equity that created.
Mm-hmm.
I mean, that's my perception.
Yeah, actually, I won't even belabor it. Those are the two as a fact. So if you go to like a financial advisor, if you go to people who don't study real estate, they study other areas of investing, and you ask them what are the problems with real estate, the number one answer that you will constantly get is illiquidity. It's not liquid. I can't get my money out today. Again, you put your money into stocks. What happens? You can sell your stock today and get it out. Even RRSPs. Yeah, you have to pay taxes, but you have to pay taxes on anything when you sell it. So you can sell them and just take money out. Like that can be a really quick thing. It can happen in hours. Now we live in a world where it can happen in minutes, where you can get your money out in minutes. That does not happen in real estate. That does not happen in real estate. And because of that, real estate gets a bad reputation. Now, again, some of that's warranted. If your money is locked up for a long period of time and you need your money, like Sandro was saying, if you're equity rich, but cash poor, and you can't feed your kids, this is not where Sandro is, but if you couldn't feed your kids and yet you're worth $10 billion or whatever, that's not helping you right now, right? So that's one big problem. The second big problem, as you talked about, was compounding interest. So compounding interest has been called the eighth wonder of the world. Usually, for most of us, it's the only thing we learned about money in school. The only thing. One thing, compounding interest. It works magically. And usually we were given the like, take a penny and you double it every day. And then how long does it take to become a millionaire? Or another way that I taught my kids is I told my kids, would you rather have $1 million? I'll give you $1 million right now. Or would you rather I give you a penny and that penny just doubles every day for a month? What would you guys do? You know it's a trick question now, right? So you know what the answer is, right? But legitimately, the answer is always go for the penny doubling. That interest, the compounding interest, the quicker money turns, the more it grows, the quicker it grows. It's like the snowball rolling down, to use a good Canadian example, snowball rolling down the hill, right? It gains momentum, it gains speed, it gains mass. So that's a big deal. Okay, so these are the two biggest problems. What I'd like to do is talk about solutions to these problems. Now, the first problem, illiquidity, it actually is becoming a bigger problem. And this is why. So I'm going to get you to think through this with me a little bit, put your thinking cap, answer this in your own head, even if you're not going to answer out loud. If you invest in real estate, how do you get your money out? What are the ways to get your money out? I'm going to let this sit for a little bit. I'll answer it, but I want this to sit for a little bit. How do you get your money out of real estate? The reason I want you to sit with this a little bit is because some of you are thinking of an answer that's actually incorrect in today's market. The real estate market is changing very, very quickly. I'll give you an example. So when I bought my first property, it was 1998. I was 19 years old, okay? That was my first investment property. Now, how does think about this, right? In today's environment, how does a 19-year-old buy a property? How does a 19-year-old buy a property? When you were 19, how many 19-year-olds do you know now with no full-time job that can buy a property? Not happening a lot, right? This is how I did it. I assumed the mortgage. No, that's something you can still do. You can assume a mortgage. You have to qualify for it and do everything else, but you can assume a mortgage. I assumed a mortgage, and this is how I did it. I paid the seller the amount of money that they wanted above and beyond the mortgage. He signed the property over to me, and I took over payments. That's how I assumed the mortgage. So 25 years ago, you could assume a mortgage. It was so easy to buy real estate, guys. So easy to buy real estate. You could buy money. You could buy deals all the time with no money down. You could just take the mortgage off of somebody else who was in trouble. They'd sign it over to you, and it was just your property, and the banks wouldn't even check. They wouldn't even look into it. I got this property for $10,000. I paid $10,000 and had my first investment property, okay? Now.
Okay, just a curiosity. Again, I gotta ask. So you paid $10,000 on a property, and I don't know if you still have this property today, but how much would this property be worth today?
So the purchase price, the full purchase price at the time was $88,000 on this property. I checked it last year. It's changed from last year to this year because it was in Calgary, and Calgary's market has been booming. But my guess is it's around $425,000 now. So $10,000, by the way, 25 years means the mortgage would have been paid off by now if nothing else happened, right? So $10,000 turning into over $400,000 in 25 years. That's pretty significant, right? And those are cool things, and that's the beauty of real estate, is the long-term effect is amazing, right? Because you can ride out the waves. Calgary has a crazy amount of waves in its market. Okay, so that's just an example of how real estate has changed, and it's changing right now. It's changing right now. One way it's changing right now is that even a few years ago, 3, 4, 5 years ago, when you pay out your capital partners, your investors, the people who are putting money into a deal, the way you would pay them out is you would refinance the property, right? Is that the answer that you guys are thinking about when you think about how you pull your money out? Oh, we just refinance. That's the most common answer. Guess what? It's not that you can't do it anymore. You can. In certain situations with certain banks, you can. There are certain lenders that do this, but CMHC does not allow it. If you have a CMHC insured mortgage and you use the money you take out on refinancing to pay out investors, it's mortgage fraud. You are going against the mortgage contract, okay? You are breaking the rules, and the banks can go really hard after you. This is something that is getting more and more serious. And if you think about it from the bank, it makes sense, right? The banks go, hold on, you're taking out all your original equity, so there's less risk for you in the end, and you expect us to be happy with it, and we take on all the risk? No, we don't like that. So it makes sense, right? So guess what the only way to get your money out, generally speaking, is nowadays? Because most people want a CMHC backed mortgage. Most people want something like that. Again, it's not the only way, but it's the most common way, right? Well, now the only way to do it is through an exit. The only way to get your money out is from sales of the property, or getting so much cash on cash returns that it eventually pays you out, which usually takes a long time with real estate, right? It's going to take at least, with the average deal, maybe 20 years or more, usually 30 or 40 years. Yeah, can you imagine? So the only way to get your money out is if somebody sells the property. Well, that's a huge problem, because with real estate, a property does best by hanging on to it for a while, for just hanging on and lasting for a long time. That's where properties do the best work, okay? So liquidity is a problem right now. Lack of compounding interest. So stocks, everyone talks about the S&P 500. If you got just an 8.5% return, and you had compounding it over a long period of time, we're all trillionaires, right? And we hear that all the time. And it's true. Compounding interest is an amazing thing. It's an amazing thing. In real estate, you don't get compounding interest in the same way, okay? Not when you're an investor, a passive investor in somebody else's project. There's really no way to get compounding interest for the most part. And so I've been working for the last 3 years on putting together a structure that works for people. And I've cracked the code on this. It's been hard, and it's difficult to do. So you cannot do this with, well, you can, I guess. It's possible with a single family home. It just doesn't make sense because it costs like $100,000 to put the structure together. And that single family home is not going to kick that amount of money out in cash flow for a long time, right? So it usually doesn't make sense with a smaller property. But I was finally able to get into a really large property. Before the property I'm in right now, it's $23 million purchase price. Before this property, the largest property I had purchased was $6 million. And with a $6 million property, again, it's just not enough money in it to make this structure work. But the structure does both things. It provides liquidity, more liquidity. It's not the same as stocks yet, but it's much more liquidity. It solves that problem. And secondly, it allows for compounding interest. And compounding interest is what I want to focus on tonight, okay? How much time do we have for this, Sandro? You're muted. You're muted.
Yeah, so I set up the call for an hour, so we have a good 44 minutes to go.
Okay, good. And just again, for those of you who are on this call, are they able to chat?
Sandro? They are, and we are also live on Facebook.
Okay.
But we can't really interact with Facebook, but we are live on Facebook as well.
No
and
worries.
I have some people interacting there.
Perfect. So anyone who has the ability to interact, I implore you to interact with us. This is information that is changing the game in real estate, and it doesn't work with small deals. It only works with big deals. So if you have questions about this, if you have challenges, if you want to challenge me on something, feel free to do that. I'd be happy to discuss with you. I'd be happy to talk about it on this call, okay? So Sandro, you can monitor that a little bit, I guess. In the background, if we see it, we'll take care of it. Okay, so we've talked about liquidity and compounding interest. Let's talk about compounding interest, how you can turn $1 have it in multiple deals, and those multiple deals can all be spitting out money, okay? So let's put the multiple deals here. I'm going to draw these out. So I know you got to use your imagination. These are all properties, okay? So this is property 1. This is property 2. And what we're going to do is we are going to show you how this dollar travels. Now, there's a caveat here. The caveat, just like in any situation, compounding interest, you need enough time to make this happen. Compounding interest does not work if you only do it for a week. It doesn't work if you only do it for 3 or 4 years. Compounding, I mean, it works, but it's not going to grow your money to how you need it, okay? Again, think about that penny. That penny can turn into millions, something like $10 million in a month, in just 30 days. But it needs 30 cycles, which in real life is 30 years, right? So legitimately, you need time to grow money in a unique way. So what if you could take $1 and you put the dollar into property number 1? And actually, we're going to use a larger amount, okay? So we're going to use $100,000, just as an example, because it's simple math, okay? So you put $100,000 into property number 1, okay? And let's say that property spits out to you cash on cash returns. And again, if you have questions about any of the statements I'm making, just ask the question. I'll slow down, okay? I'm assuming that at least everyone that I'm recognizing on the call is pretty savvy with investing, okay? So let's say there's a 5% cash on cash return, meaning you put $100,000 in. After the first year, it spits out a $5,000 check. After the second year, it spits out another $5,000 check. Again, that's not exactly how it works. It grows over time, but let's just use these numbers to give an example, okay? So $5,000. Now, there's a problem. Here's the first problem: taxes. Now, this is not a tax webinar. We're not going to be talking about taxes a lot. The first problem I see is, hold on, Mark, if you get you pay $5,000, I've got to pay taxes on that $5,000, right? The answer is, well, it depends, again, on your structure. Right now, again, the structure that I developed here, we're going to talk about it at the end, gives the cash on cash returns without paying any taxes, because it's a return of capital rather than a return on your investment, okay? So return of capital, basically it means you put in $100,000, I'm giving you out 20% or 1/20th, sorry, 5% of that original money. And because I'm giving you out your original money, you don't pay taxes on it. You already paid taxes on the original money, okay? So $5,000, it kicks out. Now, if you're able to get this out tax-free, this is the key. You want it tax-free. If you can take it out tax-free, now what you can do is you can put that same money into deal number 2, okay? So what is happening is you've got $5,000, okay? 5,000, 5K, 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 5K. Over 5 years, let's say, you've got $25,000 that you've put into property number 2. Now, property number 2, if you could do the same thing, and this is where we need time, okay? You can do the same thing, and it kicks out $5,000 or 5%. What's 5% of $5,000? What's 5% of $5,000? You got to divide it by 20, okay? So you divide it by 10, it's 500. Divided by 20, it's 250, okay? So $250 in year 1, right? Year 1. Now, every year it's going to grow. Every year you're putting another $5,000 here, which means that it's putting out another 250. So it's going from 250 to 500 to 750 to 1,000 every year. Plus on top of that, the interest of this is growing. The growth of this whole deal is growing. So it's going to grow faster than this. But $250. This is year 1. You took out $5,000. You put it in here. Year 2. Let's say actually year 2, because this is the year 2, right? This one's going to be year 1. Year 1, you get $5,000. Year 2, you get out $250. Now, you're going to invest this again. Okay? You're going to invest it into property number 3. What is 250 divided by 20, Sandro? Divided by 10 is 25, so 1250, right?
Hey, Mark, it's Baba here. I have a question. Can I ask a question?
Yeah, go ahead. Go ahead, Bob.
Okay, so sorry, I'm driving. That's why I'm not on video.
No problem.
But the question I had is, so you're basically taking the cash flow and then you're investing as a passive investor on these deals?
Yes, so this is a strategy that works with passive investing. So you're investing passively in every one of these deals, correct?
Okay, got it. So I'm with you. Okay, perfect.
Okay,
thank you.
Good. Now, one problem that you're starting to see, and you should be seeing, is that you started with $100,000, but your property 3, it's only kicking out $1,250. Okay, so legitimately, this is a small amount of money. Okay, that's okay. That's not the point. The point is, and this is year 3, right? The point is that in 3 years, after 3 years, you have $1,250. That amount, you now have it invested in 4 properties. This $1,250 here at the end, because it's working on all 4 properties, if each dollar is kicking out 5% returns on all 4 of these properties, this $1 is now making 20. This $1,250 is making 20% cash on cash now. Okay. So again, I'm going faster. So if you guys have questions, slow me down. I'm okay with slowing down here. Okay. You now have $12.50 making 20% cash on cash. If you go to anyone today, and you say,
Mark, sorry, before you go ahead,
go ahead.
just for the people on the call that are not familiar with the cash on cash, would you mind just to get into the basics a little bit?
Good question. Okay, so yeah, this is a good question because I don't want to go too fast. So cash on cash, there are 2 ways, 2 basic ways. There are actually like 8 ways to make money in real estate, okay? But the 2 most basic ways that no one disagrees on, everyone agrees on, is you have the growth of the money in the property. So this $100,000 is growing eventually to $200,000, eventually to $400,000, okay? But also it is putting out money. So tenants are paying you money, you're using that money to pay expenses. Whatever you're left with is your cash on cash return, okay? So when tenants pay you money, you pay off your expenses. If you are left with any money, including your mortgage, everything else, if you're left with any money, that's called your cash on cash return, okay? It's the money you get every year out of that deal after all the expenses.
Which, if I can simplify, is like I am calculating the capital that I put in and the capital left over. That's the calculation on that capital put it in.
Yes. Now, again, we can't forget, this is not the biggest way you make money in real estate. The biggest way you're making money in real estate is through the growth of this money, okay? So when the property grows in value by 5% or 10% or 20% over time, your money is growing in value too. And that is growing tax deferred right now. You're not paying taxes until you sell. So if you can let this money just ride, you can just let this money ride. And this is the plan. The plan I'm giving you is 20 years. Okay. So can you do it with 5 years? Yeah. But it's not going to be phenomenal. It's not going to be life-changing in 5 years. Can you do it in 10 years? Yeah, 10 years, you start to see big, big changes. 15 years, incredible. By 20 years, think about this. By 20 years, the entire original amount from this $100,000 has come out of property one, tax-free, and you've put now $100,000 into property number two. And by 20 years 20, you've now pulled out most of that money again. Okay. So what starts to happen is, again, it starts to speed up. And I had a spreadsheet that I put together for this. I ended up deleting. I was like, it's too complicated. I don't want to get into so many numbers of people. I love numbers, but not everyone is so weird, right? So I thought, no, I'm going to spare people that. Here's the basic understanding. Because you've done this 4 years in a row, 3 years in a row, you pull your money out, put it in, pull your money out, put it in, pull your money out, put it again. By year 4, this $12.50 is now sitting in 4 different properties, because you still have the value of the money you put in here, the value of the money you put in property number 2, and the value of the money you put in 3. So this $12.50 is working in 4 different properties. Well, guess what? Year 2, this has doubled. You now have $10,000 in property number 2. Your $10,000 is making 5% plus 5%. It's making 10%, the same $10,000. And by year number 2, now you have $500 making 15% cash on cash. And by year number 3, you'd have what, 12.50, 25. You got like now $30 over that, about $40 now that is sitting in here, and now it's $40 is earning 20% cash on cash. Now,
okay, so you lost me there a little bit.
Yeah.
Okay, because I got the 100,000 property 1, go to property 2. Now I put that $5,000 that I got out of property number 1. Then that $5,000 is 5, 5, 5, 5, 5. So multiples. Then what is left, which is the cash on cash? What is left after paying everything goes towards property number 3.
Yeah.
And again, by year 3, the 12.50. But then you're saying that I have $40, and that's what I got lost.
Yeah. So what happens is this amount is always going to stay the same because you're not putting any more into this property. Okay. But in year 2, another $5,000 comes out here, right? So this is now year 2. This is now year 3. This is year 4, year 5. Every year, this property is spitting out $5,000. Okay. So after 5 years, you have a total of $25,000 sitting in property number 2, which means after 5 years, this $25,000 is working in 2 different places, not just one. So now instead of just earning 5% cash on cash returns, you're actually getting 10% cash on cash returns, because the same dollars, the same $25,000 is working in both properties. Well, that works for every property again. So again, this is not going to be exact numbers, okay? But you have 250 year 3, 250 year 4, 250 year 5, okay? And this is what the spreadsheet was doing. It was just showing you 20 years, all the money and where it's growing in all these different buckets. Basically, if you think about it like this, you take your money and you put it in a bucket. The bucket is always spitting out extra money. You take that extra money and you put it in a second bucket. You put it in a third bucket, you put it in a fourth bucket. And because it's almost like seeds, if you take seeds all the time, now that seed has grown into a flower and is producing more seeds. So from that one seed, now you've got 2, 3, 4, 5 flowers. And then from those seeds, you're getting more. So you get like 30 flowers. And then from those seeds, you're putting more and you get like 1,000 flowers, okay? That's how it's working here, okay? And that's why it's compounding here. So this 1250 in year 3, you have 1250. This is the same money that was in property 1, and the same money that was in property 2, and the same money that was in property 3, and now is in property 4. It's the same 1250, meaning that you're getting 5% from this, 5% from this, 5% from this, 5% from this. Now the key here with all investing is the more you let it roll into itself, the faster it grows. And that's why I'm giving you a really basic understanding, but always saying 2 things is, 1, you got to let it ride. You got to let money grow for you. You got to use time as your advantage, as your friend. Time will be your worst enemy if you work against it. It is your best friend if you work with it. If you learn one new thing in a day, and you do that every single day, how many new things, how much have you grown in 2 years? Well, again, it's by being consistent, right? Consistency over time. That's the key. And if you talk to wealthy people, I've got a lot of friends who are wealthy. I've got a friend who's a billionaire in Calgary. I've got people who have owned ridiculously sized portfolios, like very, very, very large portfolios. And consistently, the thing that I see in them is that they think long term. They never make a decision for today or tomorrow. They never take the marshmallow now. You guys know that marshmallow experiment, right? It's a super famous experiment where they give 2-year-olds, it was given 2-year-olds, they would give them a marshmallow and they say, listen, if you don't eat this marshmallow, then I'm going to come back in 5 or 10 minutes and I'm going to give you another marshmallow. You'll have 2 marshmallows. And then they watched the kids. They just watched them. They waited in another room and watched them for 5 or 10 minutes. And they would come back and give a second marshmallow if the kid lasted it. But you saw these kids going through torture because the focus was all on, like, I want the sugar right now, right? And if we think like a 2-year-old, we don't do well in real estate. We have to think like, we got to think like the wealthy, okay? So again, the key point here is that this 1250 is now working in 4 different properties. Now, think about this over time. After 20 years, all of the original capital from the property number 1 has come out and you've reinvested it into property number 2. After 20 years, most of that capital is now working in property 3, and most of that property is working in property. It comes out. Over 20 years, these 4 properties, even after this, you don't do anything else. Even if you don't do anything else, you just start collecting the money at the back end. It's not going to be a lot of money every year, by the way, at the start. But after 20 years, it's going to grow. And as it grows, now it's still tax-free money until all of this $100,000 has to flow through all of these properties and come out into your pocket at the end of property 4 before you're paying any taxes on it. If you keep redoing this, okay? On that original capital. Now, of course, more money is going to spit out here. Again, I'm simplifying this scenario, okay? Because it gets very complex, which is why people don't talk about this. Because people don't want to learn it because it's difficult to understand. This is a difficult concept. But when you figure it out, you go, hold on a sec. My money can operate in, my $1 can operate in 4 properties. And that same dollar can be making 20% cash on cash. That is unheard of in real estate for long-term solid investments, okay? Now, here's another point. I didn't even talk about the biggest deal. That same dollar, forget about the cash on cash. Let's say, now the average deal that for me when I pay out investors, just as a bare minimum, it has to pay out about 15% growth, okay? Year on year. So what that means is that the $100,000, the cash on cash is the $5,000 after all your expenses, but this is also growing by 15%. The value of this property is going up. And so this $100,000 is worth $115,000 after a year. And then worth $130,000 after year 2, and worth $145,000 after year 3. So this money is also growing. Let's say, just as an example, let's say it's growing by 15%. So altogether, your total, the amount you get from property number 1 every year is 20%. 5% is cash on cash. 15% is growth, right? So 20% altogether. Well, guess what? What is the 1250? What is the 1250 making? 20% times 4 is what? The 1250 is now making you 80% returns. Now, if you go to anybody and you say, I am getting 80 returns on my money. Try this on the street. Go out on the street somewhere and talk to a stranger and say, did you know that I'm getting 80% returns on my money? What is somebody going to say? What is the average person going to say? What do you think, Sandro?
This is crazy. This is a scam. This is not possible. Like, yeah. What?
You say, yeah, of course you are, but you're also part of the mafia, right?
Or you're scamming someone.
Or you're scamming somebody, you're trafficking drugs or something. Like, you're doing something wrong, super risky, No, it's actually lowering your risk as you do this. The reason it's lowering your risk is because as it flows through more properties, that same dollar has been working double time, triple time, quadruple time. And now, if one thing goes wrong in one property, it doesn't sink you because you've got
Now,
your money
Mark,
working in so many different places, right?
I gotta ask because I mean, like I'm blown away. My mind is just like I'm blown away by this. Okay, because when I am underwriting properties, I am looking at 4% growth,
Yeah.
and then you're talking about 15. Like what?
Yeah. Okay. So this is the thing. I don't live in Ontario. So legitimately, Ontario has so many good strengths for investing. It really does. Truly great strengths. And it has some weaknesses, just like every place does. Alberta, where I'm from, has some great strengths and weaknesses. Saskatchewan, where I'm buying a property right now, has some strengths and weaknesses. Every market has some strengths and weaknesses. I will not get involved in a property. I will not get involved with a property if it doesn't give a minimum of 5% cash on cash to my investors.
Okay.
Now, again, it's not guaranteed. Of course, something can go wrong. But when I run the numbers, I can legitimately say conservatively, this property will give 5% cash on cash to my investors. That's the minimum amount I'm willing to do. And then my minimum amount for growth beyond that is 12%. So the minimum amount, if I underwrite a property and it's paying less than 17% total, less than 5% cash on
Okay,
cash,
so the
or less
cash on
than
cash combined
12%,
with the growth.
then I will not get into a deal. It's not worth it for me because it's not going to be super attractive to most investors, right? But again, it depends on investors. So, for example, in Ontario, because the cap rates are so low, it is so difficult to get cash on cash returns.
Well, you can still find, and then the value of the property grows faster. But then going to the example that you're showing us, and again, just so I can grasp in my mind, let's say that property that you're using the example that you invested 100,000. So let's just for the sake of argument, this is a $500,000 property that you came in at 20%, right? I'm just talking about a single family home. I'm talking about multifamily. With that strategy, considering 20 years mark on that strategy in 20 years, what I'm looking at.
Yeah, so this is where I want to be cautious, and I will tell you what. I will bring up the spreadsheet. It doesn't take long to create the spreadsheet. Okay, I'll create the spreadsheet again, and I'm going to give somebody what their money is, how much it's grown, what the value of their portfolio would be if they just use the original 100,000. They're not putting any more in. They just take the original 100,000 and they just let it grow in a compounding mindset when it compounds and grows in a unique way like this. Okay, and what I'll do is, Sandro, this is what I'll offer. I'm willing to do it for anyone who connects with you directly through Facebook or through email, text. They find you and they say, Sandro, I would like Mark's spreadsheet, or I would like the answer to your question. If they're willing to do that, I'm willing to put the time and energy in. Okay.
Okay.
We've got to make them work a little bit for it. Okay.
Okay. Sounds like a plan.
Okay. Now we talked about two problems. We talked about liquidity, and we talked about compounding interest. Now we figured out how to compound your money. Okay, we figured that one out. It's difficult to do in real estate. It's possible. Okay. The second big problem is liquidity or illiquidity. How you just can't get your money out of a property. It's very difficult these days. Well, there are certain structures that basically here. I'm actually going to bring up my screen. The only way that I know, and I'm sure there are others, but the only legal, upright way to get investors' money out in a short period of time with an investment is to replace that money with somebody else's money. Okay?
Okay.
So again,
I'm listening.
It used to be you can refinance, you can do those things, you can exit, but I don't like exiting properties. Every time you exit a property, you pay taxes. And I don't want to pay taxes. I mean, I will pay them. I have to pay them. I'm not against paying them, but I don't want to make it easy for my money to disappear. So my job, in my opinion, is to hold on to that money as long as possible, grow it as much as possible. The longer I hold on to it without paying taxes, the better. So I don't sell my properties. So an investor working with me, they're in trouble if the only way to get their money out is through a sale, because I don't sell my properties. So there are two ways to do this. One way, okay, I'm going to put this. How do I get my money out quickly? Or when I want or need it. Okay. This is the $1 million question. Okay. If you can answer this question, you are now in a good position, because the way the average deal works is you put your money in, and it's going to take at least, like, there are flips, right? Short-term deals where you get your money out within 6 months, within 12 months, within 18 months. You take on a different risk profile with that, because it now depends on what's happening with the market at the same time. I'm a long-term investor. So with long-term investors, it's going to just take forever to get my money out. And that's a massive problem for investors right now, okay? You run into a problem, health crisis, whatever. I'll tell you a really quick story. My uncle, who invested in real estate, by the way, he did really well with real estate, and his wife, my Auntie Jean, got sick with an autoimmune disease that no Canadian doctors could fix. So she was living in Kelowna at the time. No Canadian doctors could fix this. My uncle found out that there was an American doctor that was practicing in the US that claimed he could fix this problem. Not completely, but he could, instead of my aunt having 6 months left to live, he could give her maybe another decade or so.
Oh, wow. Okay, so you jump on it.
What's the value of allowing your life partner to live another 10 years on this planet? Well, my uncle was willing to do anything. Most people, their choice is, I have to mortgage everything in my life and pay debt for the rest of my life, or this person dies in 6 months. That's the average person's choice. My uncle, because he'd invested a lot in real estate, took out a loan, which is another way to get the money out, right? Somebody else is putting money in. You take the money out, and because he was able to take a loan on his property, he was able to get that surgery, the procedure. I don't know exactly what it was. I was young at the time, but she lived for another, like, it was something like 9, 10, 11 years. Right?
Wow.
Amazing. To me, that's where real estate has value. We need to be able to take care of our families. We need to be able to do the things that mean the most to us in life, and gives us an opportunity that otherwise we couldn't have. And real estate does that, but it's illiquid. Can we get the money out when we need it? So
Can I give an example? You're mentioning this, right? So I got into real estate, and I'm an action taker. Let's go, let's go, let's go. And I went in a buying spree, like spread. I was buying like crazy. Now I'm facing a dilemma, because I do have other individuals that trusted their money into my deals, which, when I purchased, the projections, they were solid, because I wasn't expecting to have 400% interest rate increase in 10 months. And now I'm like, oh my goodness, how do I pay these individuals out without having to sell the properties that are good properties? And in the long term, they will put in that position that you're mentioning. And that's when, as we're speaking, I'm thinking, oh my goodness, I have to then find a new money with a new individual to then get that first individual out, and still keep the property.
Yeah. Yeah. So here's the thing, and I'm going to repeat this. I was writing it while you were talking, just because I don't want to spend all my time writing when people are on this. But the only way that I know of, the only way to get your money out is, when you want to need it, is if you're a passive investor, is to have someone buy you out. Now, think about this. What are the different structures or entities of people that buy you out? A purchaser, right? You sell the property, and the purchaser buys you out. Right? So the new owner buys you out. You sell, they buy. That's one way. Okay. The second way is the bank or the lender. They give you, it used to be, they give you a refinanced mortgage. They refinance the property and they pay you out. So they put their money in and buy you out. Okay. There's another way. Actually, so the lenders, this is like 2A. And this was through refinance. That, again, it still exists, but you guys, believe me, this is going away of the dodo. This is not going to exist a lot longer, and it's definitely not going to be as easy as it used to be. investors are going to suffer because of this. A lot of promises have been made to people, and those promises are going to be broken. It's a very difficult thing to do now, okay? It's not impossible, but it's very difficult. The next way is for a bank or a lender to give you a line of credit on the property, backed by the property. So this is very common in single-family homes. This is the most common one in single-family homes, okay? It's less common on multifamily, on big commercial deals. Doesn't happen as often. It can, but it doesn't happen very often, okay? The third way is an investor. This is the third way. An investor buys you out, okay? Now this begs the question, how easy is it if you're in a joint venture deal? If you're in a joint venture deal, so in a joint venture deal, you've started a corporate structure, you've started a business with your other partners, right? And again, there are some strengths to the way of doing this business. So I'm not saying this is evil, I'm not saying it's bad. Know that, okay? Everyone understand that. I'm not calling things evil right now. I'm just giving you a good understanding of the advantages and disadvantages here, okay? If you have a joint venture partnership, a co-tenancy agreement, shareholders agreement, whatever it is, you've started a corporation with this other group, often they have to say it's okay to get out. Often you have to give them opportunities that may be a cheaper payment, right? Maybe you take a haircut for it. Or maybe there just aren't any other investors that want this deal, so you just don't get out. Because maybe these investors don't like the way the deal is structured, that corporation is structured. Maybe they're buying into it and they're like, I don't like John or Sue, and so they don't get into it. So this has been problematic for JVs, okay? Not impossible. Again, I'm not saying it's impossible or bad. It's just difficult. What I've started is called a mutual fund trust, okay? What a mutual fund trust is, again, it costs a lot of money and time and energy to put this together. I've been working on it for 6 months now, okay? It's just coming to completion within the next week or two here. Really excited about it. What a mutual fund trust does is, number one, we are always raising capital, okay? Because we're always raising capital, after the first year, Sandro's invested with us. The first year he says, I want my money out, guys, or I want just $1,000 out, or I want $5,000, or I want $50,000. He decides on how much he wants out. He lets us know with 60 days notice, and then we raise capital because we're always doing this. And this person A, is bought out by person B. And it's simple. It is not complex. You don't have to go through the ringer for this. You don't have to talk to 18 different lawyers for this. It's simple, okay? So mutual fund trust, we're always raising capital. Therefore, right, you can take your money out far more easily, okay? So this helps with the liquidity problem, okay? It's not solved. It's still real estate, okay? It's not going to all of a sudden become, oh yeah, you can just take your money out next minute. That's not real estate. It's the way it is. Real estate has other advantages, but it's making it far easier.
Pode voltar ao vivo, para ver se tem algum. Será
Sorry?
que André Fernandes tem algum vivo?
Oh, okay, just an interruption. Okay, so number two, a mutual fund trust. We talk about liquidity. We talk about compounding interest. Pays out as return of capital. Okay? The cash on cash returns. Remember we talked about cash on cash returns? In a joint venture deal, that is not. It's taxable. Every year, the money that comes out of that deal is taxable. Every year with our structure, we pay out original capital. We return somebody's capital. So until all of that capital is paid out, until all of it's paid out, that person doesn't pay taxes on that capital. So they can reinvest. So we're taking care of that problem. Now, there are other problems, okay? Other solutions to problems. For example, how many people have RSPs that they want to invest in properties, or TFSAs, right? Or get into a huge deal in a major Canadian market, downtown. Okay, so for example, now you can get into deals where you're working with people who have far more real estate experience. Again, I started investing in real estate when I was 19 years old, okay? And I wasn't doing it right at that time. I got lucky, which is not something you want to rely on. But I've learned a lot since then. I've seen lots of market cycles. I know how to protect myself in different ways, okay? So there are lots of things that come down here. Other solutions, risky What is risky? Listen, in all real estate, in all investment, in anything in life, you can lose your money. So I'm not saying that's without risk. I would never say that, okay? But how risky is a deal? You know how I was talking about flips before? Flips tend to carry the same amount of risk. You could still lose your money. It's the same amount of risk. But one is riskier and one is less risky. What makes one riskier or less risky? It's how you can mitigate the risk. How do you take away the sharpness of the risk? I'll give you a quick example. This is the way I explain it to everybody. When my son was 2, my wife wasn't excited about letting him cross the road out front of our house. Okay, we had a busy street. We weren't excited about letting him run across the street. Why? Favorite says, well, he'd get hit by a car. Say, but I crossed the street. Could I get hit by a car? Say, yeah, but. That but is risky. The yeah is risk. My son and I have the same amount of risk when we cross the road. We both can get hit by a car. That's a fact. We both could get hit by a car. The difference is that I have, my age is 45, okay? I've got 45 years almost experience of crossing roads. I've crossed roads in Egypt. I've crossed roads in China. I've crossed roads in a whole bunch of different places that are not the same as crossing roads in Canada, okay? And because of that, I have life experience. And so I still have the same risk. I could still get hit by a car. The difference is that it's not as risky for me because I have so much experience. Because I have so much experience and life wisdom, I can cross the road relatively safely. Could I still get hit? Yeah. Same with my son driving. He asked me the other day, he's 12. He asked me, Dad, can I drive just a little bit? I said, no, you can't drive. He said, why not? I said, because for you it's dangerous. For me, it's less dangerous. I didn't say it's not dangerous. Okay, I could still get hit. I could still hit somebody else. There's ice. It's Canada still. There are lots of things that can go wrong. The risk is there for both of us. But I have 25 years, almost 30 years of driving experience. My son does not. And because of that, it's less risky for me. So would I let my son drive? No. Well, could Mark still get hit by a car? Yeah, but the yeah is the risk. We could both get hit by a car. The but is Mark has a skill set to take care of some of the risk. It doesn't take away the risk. It takes care of some of that, the probability of realizing the risk, okay? So to me, when you get into a massive deal in a major Canadian market, downtown, that has the same risk as investing in a one-horse town in Timbuktu. It's the same amount of risk. You lose your money. One is less risky. Why? Why do people pay more money to get less out in Toronto? Why does Toronto have a lower cap rate than Calgary? Is it because Calgary has more or less risk? No, same amount of risk. You could lose your money in Toronto, you could lose your money in Calgary. But in Toronto, because it is so much bigger, because it is so much more, if you were in Alberta, forgive me for saying this, because Toronto is so much more important for the Canadian economy than Calgary, same risk, but it's less chance that you're going to lose all that money. There's less chance because Toronto just has more momentum. It has more momentum, more size, more needs to go wrong before you lose everything in Toronto than you lose everything in Calgary. And you know what? The same is true of Calgary to, again, a small village somewhere in the prairies. In the prairies, now I go with Calgary. I'm willing to take less money out of it because my risk, it's still the same amount of risk, but the chance of realizing that risk has lowered, okay? And to me, that's why I'm doing this. And actually, we don't have, it's running up against the hour pretty soon. I want to stay with time. I don't want to go over time with this, but I wanted to whet your appetite because actually we created this mutual fund trust for it gives about 6 or 7 huge advantages over the way people are investing right now. And I've been so excited. I've been waiting honestly 5 years to try this out. And I just didn't have a big enough deal that made enough sense. So I finally found the deal that makes enough sense for this to actually take care of investors in a really unique way. Now, is it perfect? No, nothing's perfect. Everything has disadvantages, right?
Yeah, and I just want to say quickly because I have 6 minutes to go, but then this is a 70-unit apartment building that are converting into 100.
Yes.
The question is, how?
Yeah. Yeah. And you know what? We will wait for that for what is it, the next webinar, March 13th?
Yes.
Okay, so let's wait for March 13th. I'll explain a little bit more there, but know that like my desire is to teach people. I want to teach people how to think. You need to think differently if you're going to succeed in investing. There's no investor, sorry, I got to be real careful what I say here. The percentage of investors that do really well without knowing what they're doing is very small. You can get lucky for 1 year, you can get lucky for 5 or 10 years. It's very difficult to get lucky for 50 years in real
Yes,
estate.
and
You
this
have to
is
do
a
it well.
very important statement because when I started my professional investing career, which was 2020, and I like it was very easy to find capital. It was very easy to find deals. So put the offer accepted, negotiate, get the capital, and do it.
Yeah.
And then now that I'm finding there are still individuals thinking, oh, I want a deal that I get all my money out in 2 years. And I'm like, now that I keep educating myself, right? Especially because the size of challenge that I'm facing are enormous. So I need to find safe ways to basically pay everybody out and still either save the deal or reposition the asset, am I not? And is pursuing education and learning how to think. So I'm very grateful that you took some time of your very busy life to come and start sharing these conversations with us. Again, I hear a lot of individuals saying, no, with single family homes, you only lose money. Or to get in a massive deal, you got to have a lot of money. And I just learned in this past hour that I can actually be very successful if I'm doing with single family homes. And if I'm looking at the long term and I want to get into like a 70-unit apartment building that is being converted into 100, I can also participate without having to have like millions of dollars. So, Mark, I am so grateful, and I would want to be mindful of our time. So, if anyone here on this call want to connect, will have some questions, want to understand better, and see Mark's spreadsheet, it's some real numbers, like just to have an idea of okay, I'm putting the 100,000 and this 100,000 in 20 years, what it look like. Please send us a message. You can find me on Facebook, Instagram, TikTok, /Sandro Canada. Please send me a private message or even on WhatsApp. My number is 613-402-1001. And then I'm going to send the messages to Mark so he'll send a spreadsheet to at least give a perspective. And Mark, another reason why I'm so grateful is that I'm coming from a season of grief because of this massive debt that I got myself into it. And I'm like, I'm dead. And just by talking to you and showing different ways that I didn't even think about, that I can save what I'm being invested, I can save the investors' money, everybody can be paid out, and I can move on with my life and build a future that actually makes sense. It's not 1 year, not 2 years, but in 20 years I'll be my like late 60s.
Yeah.
And my dad is just turning 77, and it's like it's going, so I can be in a much better position than my dad is, right? So, anyways, for everyone that participated, so again, Sandro Canada or my cell phone or WhatsApp or Messenger, send me a message, and I'm gonna ask Mark to send just an example. If we buy a property, 500,000, using this strategy, what are the numbers in terms of projections would look like?
Yep.
And then in 2 weeks from today, I want to keep learning. So I appreciate that very much. And let's get it done. So for everyone that is here, have an amazing evening. Stay blessed. Buy the best. And I see you guys in 2 weeks. So Mark, once again, I appreciate your time. Much appreciated.
Anytime. Enjoy
Thank
the
you
night,
very
everyone.
much.
We'll see
Thank
you.
you very much. Bye.
Thank you.
Thank you. Bye.